When clients come to see us and they'll say, well, they usually start with, how should I invest my money? And we jokingly say, how the heck should I know? Because we actually don't know at that point. It's like, A, where are you? B, where do you think you want to go? Then maybe we can figure out how to get from point A to point B. But there's a lot of work in both of those. In the first stage, where are you? That means really digging into someone's financial life. If you want to use a doctor's analogy, it's really a full physical. Where are you completely? What is your debt situation? What are your assets? What about stocks, bonds, pensions? Are you matching your 401k? Everything has to be seen first. So asking how we would invest someone's money at that stage is unknown. So after you figure out where you are, then we can start talking about where do you want to go. And that's the retirement planning. It's doing the math to see, are you saving enough? Do you have enough time? When do you want to retire? There's a few variables that you can alter. You can work longer, you can work harder, and your life expectancy is going to be what it is. So we will assume the best. You're going to live to age 90. Do the math. You're here, you want to retire at this age, will you have enough money to live on? Depends. We can figure that out. When we do figure it out, the one thing we know is that that analysis is wrong. There's too many variables, but we at least get a general idea if someone's headed in the right direction. We're going to have to redo it every few years. What if the markets have a hit? Or what if they're fantastic? We can change as you go. We dial into a specific idea of where the client wants to go. And that takes a lot of conversation. We tell some clients, okay, you can spend X. And they might say, oh no, I've been in saving mode all my life, I can't possibly spend that much. Okay, then what's the implication of that? The money keeps growing and your great-grandkids are spoiled rotten. So every financial move has implications. So after we figure out where you are and where you want to go, we can start talking about potential paths, potential directions. All of them are based on our philosophy of the stock market and the bond market and investing in general. But there's leeway. Different clients might want different risk levels, so a client's preference and personal situation will come into play. And then we'll try to take their ideas and merge them with our philosophy on investing. And we're going to try to convince the client, of course, that that's the proper investment philosophy. There's a lot of investment philosophies out there. There's a lot of paths from A to B. Some we think are too dangerous. Some look really fun, but the danger level's too high. We always use the mountain climbing analogy. We're on this trek. It's a month journey. We're heading up the path, and we're forcing clients to carry their safety gear. And they'll say, well, look, it's sunny out. Why can't we leave this here? We'll make faster time. That's the path we think is safest. Carry your safety gear. You might need it. And then they might look over and say, hey, those people over there are just scaling straight up the ledge without any ropes. They're making really good time. Yeah, we're not going to do that. Keep going on the path. We're not going that route. Too dangerous. You may think it's fun, but the winds might come up. A lot can go wrong. So stay the course. And there's multiple paths they can take. But we're going to steer them clear of the ones we think are too dangerous, or the ones that we think are not going to get them there on time. That's what we've been doing for 50 years, is determining what the best course of action is.